to a little above 85, 86.32, sort of gaining a little strength this morning in early morning Asian trade, up about 0.5% after what could only be described as a roller coaster, one direction yesterday. The biggest drop in over a year, losing over $5, which is sees a plunge through the 50-day moving average. It's down $10 in a week from touching the lofty heights of above $96 on Brent, and now we're $10 below that. October has been a little vicious so far for the oil price. For those who like to see who are long position, most of the market in a long position, and of course that's after a bumper Q3 where we saw a 30% jump in the oil price. But perhaps this is still a little bit of a correction. Let's kick off this morning with Dr. Youssef El-Shamari, CEO and Head of Energy Research, C Markets, a Senior Research Fellow at the Imperial College of London. And of course, what appears to have dropped off his long title is former OPEC researcher and consultant. So, Dr. Youssef El-Shamari, I'll ask you to put on your former hat and give us a sense. We need to sort of get a pulse here. What exactly do you think is going on? This is the quarter in which OPEC forecast a 3 million barrel a day supply deficit. It seems we're a long way away from that at the moment. At least the price would indicate. Your thoughts?
Hi, Cian. Good morning, everybody. Good morning, Bora, and all the Gulf Intelligence team. Definitely, it's a surprising return in terms, if you look at the price movements, because at some point we've seen forecasts by various investments back, not even our forecast, that we're going to hit $100 and maybe even higher than that within the next few weeks. But I think the message coming from central banks about tightening monetary policies, the continuous inflation levels that we're seeing, and also the possibility that we could see interest rates going as high as 7%, especially by some investment banks, has really had made an impact on the price movement. So I believe this is a major concern, and possibly we are not going to see a soft landing. Possibly the prospects of recession are going to be priced in by the markets, by the current price movement. That's one major issue. Another issue is the supply. If you look at the U.S. oil production, currently it's at the highest level that we have ever seen, 12.9 million barrels. And this is another reason. So there is plenty of supply that is coming from the U.S. Iran is ramping up its production, Libya, and many of even OPEC member countries who are not member of the pact or the OPEC Plus agreements. And I believe this is another reason why we're seeing prices also a bit falling down. So the issue here is the economic outlook, especially with tightening monetary policies. We can see a recession, and also the increment in supply that we are seeing with different oil producers. And one major reason why Saudi Arabia and Russia have decided to keep their voluntary cuts fixed from now until the end of December. Otherwise, if we could see a really, the rally has actually continued to above $100, then possibly I could see where we might have seen a rethink of the policy.
Clearly, they stuck with it yesterday. Bora Bariman, managing partner at Hormuz Straits Partnership. Somebody got it horribly wrong, it would appear, at OPEC headquarters to call a 3 million barrel a day supply deficit. IEA said 1.5, half that amount, and way back in third place, the Department of Energy in the US seems to have called it a 300 supply deficit. Your thoughts, Bora, as to what has sort of given this market a big shock yesterday in particular, but of course over the last week, this $10 correction? Do we have Bora on mute? Yes, Bora does not want to be heard. He will unmute
Apologies
himself.
for that.
Yeah, please.
I'm not an oil analyst, and I do find the debates on the podcast very interesting, as a consistent theme of the experts here has been questioning the peak oil calls that have been emanating from the IEA, as you alluded to the forecasts of deficits and the debate between OPEC and the IEA. But I'm leaning toward questioning actually the many peak interest rate calls that have been made and missed this year that are keeping these markets in the volatile flux that we have been experiencing. The U.S. government bond yields are rising and rising because the sovereign and private investors are selling bonds. This is the so-called risk-free asset, right? U.S. government bonds, the price at which the U.S. funds itself. No other government or business in the world can get cheaper capital than that. And still, there's pressure pushing that up. That's not going to be a comfortable place for commodities that are relying on a robust real economy to absorb these inputs. And but on the other hand, India's humming along. We see the banks, Citibank calling a bottom to China's slowdown and seeing acceleration coming in there. So the point is, it's very hard to call that peak interest rate point.
Is it? I mean, is it? And I come back to the question that we've discussed before, that the markets, the financial markets in particular, just have been, it seems to a certain extent, tone deaf. They don't hear the bearish news, they just hear the bullish news. I mean, I don't think the Fed could have been more clear this year that their determination to fight inflation is top of their agenda, and whatever it takes to achieve that. The financial markets just don't seem to want to hear that narrative.
Look, they're hoping and expecting this peak, right? Because and they're anticipating a reduction in interest rates.
But it seems now they've finally woken up. I mean, is that what the markets are telling us in the last week or two with the yield curve?
Actually, I think they're looking for some weakness. They're looking for a deceleration of the economy, some type of contraction in demand, right? These are the bulls, which I'm referring to.
Yeah.
That would prompt the Fed to ease up on the money supply and the interest rate, that helps markets sort of froth away to a higher level. But the issue there is inflation. We don't see that it has been kind of comfortably brought into the 3% target, much less the 2% target. And my view is, we're in this multi-track world. So whose world are you talking about? I think from the Fed's point of view, it's just about America. The American economy seems to be humming along at this almost peak employment state, which is precarious because there's a political concern around it. But I'm wondering if it's going to be a kind of a Coyote and Roadrunner type landing. So we just sort of go out, and then a very unexpected abyss brings us to a retrenchment across the board. So what we've seen, I think, this week is a theme that will be played out in the weeks and months ahead. I think repeatedly, a kind of a froth, a euphoria, and then a correction, as you termed it at the beginning of this.
Well, that's the question ultimately, Yusuf. And I suppose if you're in Riyadh or in Moscow or in any OPEC plus capital, you're trying to assess, is this a wobble before that tightness arrives, that sort of, according to OPEC, extreme tightness, a 3 million barrel a day deficit on supply coming in this quarter, IEA half that amount, still a big number at 1.5 million barrels deficit, or are they all way off, and that China crisis is greater, that we talk about the US there, the Fed, but the China demand outlook probably a big fracture in the consciousness. Your thoughts of whether this is a wobble before the tightness arrives, or are we finally getting the big recession that we've been warned about for the last year that has never arrived? You're on mute again, Yusuf. Sorry, contagious.
Okay, well, I think Michael, the market will continue to be volatile. So that drop in prices might not be sustainable. And I think the market will wait and see until how the economic picture will look like. If we end up in a higher interest rates and the economy in the US or Europe starts to slow, and we see, for example, a reduction in employment figures or reduction in wages and all these macroeconomic pictures, that shows that there is really a slowing down, and we are not going to go a soft landing, then I think prices will continue to fall further, and then you will have OPEC Plus interfering. Possibly Russia will will make the further voluntary reductions, try and bring prices to maybe to the $90 levels.
I mean, in a weakening market on the macroeconomic side, can you cut your way to a $90 handle? Can you cut without demand outlook remaining relatively solid? Can you cut your way upwards again?
Well, yes. If you're going to shorten supply, prices will increase, because it's ultimately a supply and demand balance. So if prices fall and the further you cut, then that will bring prices.
Is it not a case? I mean, this is the ultimate question that I would have. Is OPEC choking the golden goose here by trying to cut its way to 90 plus, and ultimately a very fragile, with a strong dollar on top of that, you're inevitably going to choke demand?
Well, could be correct, but the level at which we going to see demand destruction might be $100 or higher. So at $90, I think for consumers like India, it may not be a problem, but even $100 for India might not be a problem, even for China, but other emerging economies in Asia will start to suffer. But when that would happen, when we hit $100, then that's why I said when we see $100, then I could see an easing in supplies. So that's when we talk about Asia picture. But when we talk about the US and Europe, I think they can still live with $100, because I think even higher than $100. But here, all I wanted to say is a $90 is a possibility that we could live up with. But that the situation can be volatile. We could see $80 if the economic picture continues to deteriorate with higher interest rates and no change in OPEC Plus policy. And here I'm referring to all, whether it's Saudi Arabia voluntary cuts and Russia, or the whole group as an alliance. So $100 may not be achievable within the upcoming few months, especially if the interest rates continues to go higher and we don't see an improvement in the economic situation. Whether it's the market tightness is an issue, whether the market tightness is an issue, yes, but here the economic outlook is weighing more on the supply picture. Yes, I definitely agree with both OPEC and the IEAs regarding, because we continue to see stocks falling. Just in the US, week after week, stocks now are close to 400 million barrels. But I think the economic picture is having a bigger weight on where prices are currently trading. And by the way, they are not very low now. So $90 is not a low price. It's still a high price, but it depends on where suppliers really are considering a fair, or let's say here, a price that they see as stable market, and where prices where they see it as unstable markets.
Yeah, we're kind of Bora, at the sort of 2023 average, $85 average on Brent this year. We've kind of come back to that. So still a very generous number. It gives most countries in oil producing countries, certainly in the Middle East, into a balanced budget, if not a small surplus. But when you combine this dollar number with the strengthening dollar recently and the 5+ interest rates, I mean, not 5+, US mortgage rates last week topped 7.5%, the first since November 2000. The 30-year fixed mortgage, it's over 7.5%. The combination of those three things, it's very difficult to see any developed economy, never mind emerging economy, to be able to sustain that.
Well, my view is they're going to have to get used to these higher interest rates because
with strong dollar and $90+ oil, they can all coexist.
I'm not sure about $90+ oil, but the issue is investors into a government debt, they have to look at what 10-year inflation is going to be before they invest into a 10-year US government bond. And that is a very uncertain world if you're trying to look at that. And I don't think there is a narrative. Well, anything's up for debate, but I don't lean on the side which says we're going to come back to, a world where deflation is the major risk, which was what the official narrative was maybe just 3 years ago, right? That deflation was the major risk. So I think inflation remains on the forefront of financial markets. Now, with these higher interest rates, there's a greater awareness of fiscal policy and deficits, and hence there's going to be the continued, let's say, psychological pressure of what happens in the US Capitol, because they're going to be viciously arguing about whether to cut spending or to have higher deficits, or is Ukraine a priority versus some other domestic concern. So I don't think we're going to be sailing back into calm seas anytime soon. And for the time being, I think for the next, let's say, rest of the year, I don't see the tone out of the Fed is going to change either. They'll continue to stay fairly hawkish, right? But again, markets were looking for the peak call where they could start partying again and things could froth up, and maybe the oil price got caught up in that. But now we see more soberly that inflation remains an issue, although economies are slowing, and that's a double dilemma, hence kind of the sell-off across markets.
Let's go to the survey question, because I think ultimately this remains a critical question, how you answer this. Because ultimately, if you answer number one, you've got to say $100 oil comes. I mean, you can't have 3 million barrel a day supply deficit in the fourth quarter and not get to, knocking on the door of 100. I just don't see 3 million barrels a day deficit. That's massive. IEA at 1.5, still a bionic number. I think we're, the market's saying it's Department of Energy at 300K. What do you think? Which of the energy agencies got it right with their call last month on the supply deficit for the fourth quarter? Where do you put your money? Youssef, inevitably everything now, I mean, from an OPEC plus point of view, the front month is clearly the contract is December. We're already talking about New Year deliveries at this stage in terms of the market, forward market. And typically that is a weaker quarter, the first quarter from a delivery point of view. I mean, looking beyond the immediate noise of this, front month drop and into the new year, what's your sense for the first quarter? Are we going to get this the sort of economic weakness we were promised, the recession, or do we get China coming back? What do you think the sentiment going into the first quarter? Because inevitably OPEC plus meeting in the next big meeting in November, it's all about what happens. What's the outlook for 24? What's your outlook for 24?
All right. Well, Shane, it's in 2024. Well, I believe we're going to see a higher demand, but it will not be as big as what we saw in 2023, and that's because China again has just emerged out of a 3-year lockdown, and this year the demand outgrowth was somehow close to 1 million barrels, maybe between 800 to 1 million barrels. So.
Most of which went into storage, it seems, in terms of imports.
Yeah, yes, but still, but they have emerged from lockdown. So if you calculate their year-on-year growth, that will be the biggest. But next year, so this year we saw growth about 2.3 according to OPEC data, and between 1.5 to 2 million according to IEA. So I believe next year we're going to see demand between 1 to 1.5 million barrel of growth, but that means it's still let's say an average number if we look at the data prior to the COVID pandemic. So it means that we're trying to come back business as usual, because we have, since the emergence of the COVID pandemic, the growth has been much higher than the 2019 levels. One issue here is that what supply policy we're going to see. So I think for the meantime, OPEC Plus is keeping its as a group, they're keeping their cuts in place until the end of 2024, which means 23. They think that even 2024.
Oh, really?
Yes.
You think they'll keep this voluntary
cuts? Voluntary until 2023, but we have 2 other cuts being in place until the end of 2024, and these are the 9-member voluntary cuts, 9-member countries, and the whole cuts from the whole group. That is around 2.3 million barrel of whole total cuts. That's in place until the end of 2024. And on top of that, you add the Saudi voluntary cuts, which are just for this year, and they are extendable. So one thing here, I think that maybe the Saudi voluntary cuts will start to ease. I don't think they will bring them back and let's say all of a sudden beginning with 2024 or 100%. I think they will start gradually bringing these barrels back, depending on where demand picture is. And I don't think with the demand in Q1 will be much better than Q4. I think it will be somehow close. But as we move towards the summer, then I think, yes, we could see $100 price. I think many forecasters are seeing that, especially from the financial industry. And then I think we could see a full possibility, and that's a scenario. I would say that's the likely scenario where we see a full returns of the Saudi-Russian voluntary cuts to the markets, and that is if we see prices $100 or more. So I think 2024 is possibly going to come back to a business as usual scenario. Another reason here I'm saying that is it's an year where we could see central banks started to cut rates. And that's just another issue. So if we see them starting to cut rates, that will be a boost to prices. And then we could see both cutting interest rates and an ease or more increment supplies coming to the markets, trying to, let's say, which essentially could mean that they're expecting prices to be high. That is our supply on a supply picture. So in the demand, we could see demand at about 103 million to 103 or 5 million barrel. Okay, so 103 and 500,000 barrels.
103.5.
Yes, this year it's 102 million. On the supply side, we could see supply going up to by let's say a million barrel more. This year it's about 100 million barrels, so we could see 101. And these are just rough estimates that we are making now. We will make our accurate estimates end of 2023.
Let's get the survey result and give Bora the last word today. Bora, this is a kind of a divided room as well, small sample, but nonetheless we'll post on social. Nobody seems to know who's got it right. But Bora, I wanted to get your thoughts on how we should read the tea leaves on the currency exchange, the sort of the recovery of the dollar. We'd sort of, the narrative through most of 23 was that the dollar had peaked and we were now moving into a weak dollar cycle. The dollar's come back. We've got Brent, we've got yen at 150. We've got euro at 105. We've got the Chinese yuan at its weakest level in a number of years. Your thoughts on what the strong dollar tells us going into the end of the year, and it's sterling holding up, it would appear, at over 120, but your thoughts on the currencies and where we're going into the new year as we're now trading in oil, at least December contracts.
A few points on that. One, strong dollar indication that markets view the U.S. Fed as being relatively the most credible in its hawkishness as compared to the Europe, UK, or Japan, that they can kind of hold the line on maintaining interest rates at these levels. I'm not saying necessarily above, but essentially these levels without having to resort to rate decreases, which I believe are being more seriously discussed in other developed economies. Secondly, again, in bolstering that narrative, we do hear Fed governors talking about the risk of higher oil prices, energy prices on their inflation targets, hence that they will need to bolster their hawkish stance for longer. And again, America is at the center of the world system, so it has a very kind of all the access to the resources it requires. They have the energy production, right? They have the food production. They've got the capital. They've got the technology. So investment increasingly is flowing into U.S. markets as opposed to the Frankfurt Stock Exchange or the Tokyo Stock Exchange. It's going into America. On top of that, American capital at least is spooked away from the opportunities of China. Yes, it's going to India a bit, but India doesn't have the absorbing capacity that China once had. So again, all this capital is kind of, I would say, pooling in America, hence creating a relatively stronger U.S. dollar for the time being. But all eyes on the rest of the world, right? China and India, emerging Asia, what do they do? But at this point, I think the narrative is being set in Washington.
There are all of those things. There are all of those big themes and the big macro factors. And then there is the structural markets. I think that's really the thing to watch today and for the rest of this week, because the market structure has to reconfigure itself as in terms of the oil moving below the 50-day moving average, moving below the 100-day moving average, the 200-day moving average moving below the 100 and the 50. So structurally, the market is now in a completely distorted place, and traders and banks and fund managers are going to be very busy today trying to get their book back into some kind of balance. And where does that include shorting this market? How much short? Because the market is so heavily long. I think that's the thing to watch today, the restructuring of the market. Put aside all the macro, all of the big the big themes we've talked about and talk about a lot, but structurally, traders will be very busy today trying to get their house in order, and it will be interesting to see where the new parameters, trading block parameters move into place and how much this market gets shorted. Thank you so much, Bora Bariman, for your insights and joining us today, as always, and also Yusuf, really appreciated Dr. Yusuf El-Shamari, also for providing the insights today. Oil markets, as we said, trading up about 0.5% this morning after yesterday's massive slaughter of $5 drop. Thank you, guys.
Thank you very much.
Thank you, Sheen. Have a nice day.
You too. All the best.